Hey everybody, this is Jason Ostrowski, and welcome to another edition of the Everything Real Estate Podcast. In this episode, I'm happy to welcome Prosperity Home Mortgage's own Mike Walsh, who is the regional sales leader out in Chester County, PA. Mike is an 11-time Chairman's Club award winner, bringing a wealth of experience to our discussion today. In this episode, we'll explore the intersection of interest rates and buyer psychology. As we all know, interest rates can significantly influence buyer behavior in the real estate market. But if we go beyond the numbers, psychological factors play a crucial role in buyer sentiment. In this episode, we'll delve into how current interest rate trends are shaping buyers' perceptions and decision-making, and discuss strategies for navigating these psychological dynamics in today's market. Mike and I are going to do our best today to put ourselves in a buyer's mind and touch upon what we're seeing out there in the marketplace today. So let's get right into the episode with Mike Walsh, and we'll pick it up on the other side. Mike, it's great to have you here on the podcast with us this week. We're actually recording this episode the day after the Super Bowl. And as you can see, I'm sitting here in my vintage Jerome Brown, Kelly Green Eagles jersey here. So my first question I have for you is, are you still bathing in the afterglow of the total domination over the Kansas City Chiefs by your very own Philadelphia Eagles last night? Wow, what a game, right?
I am. How do I feel? I'm speechless because the game itself was something unlike what we're typically used to, in that after, the first quarter and a half to certainly halftime, you felt this confidence level that just was not normal for us. So yes, the afterglow is real. I have two sons, and they're 9 and 12. So my 9-year-old, it was his second birthday when the Eagles won their first Super Bowl. So watching him watch the game and be so happy about it last night was definitely the highlight for me. And then my 12-year-old, it's like he doesn't understand really what we've been through as Philadelphia fans, because he's seen the last 12 years of mostly joy where, I'm like, Joe Carter hit a Game 6 walk-off home run against the Phillies, and it almost destroyed my whole entire childhood level of Philly fandom. So my happiness is through the roof right now. How about you?
Oh, man, I'll tell you what. Yeah, these kids don't know how good they have it, because I have never experienced pain. You bring up Joe Carter, which was very painful. For me, it was the 2002 Tampa game, NFC Championship, that I still tell my wife to this day, I am still not over that game. That was like a crushing blow. I don't know how I survived past that point. I think I died inside at that point. So
Rondé Barber.
Oh God, Joe Jaravicious. Oh my God. Well, we could reminisce about painful Philly sports all day, but I wanted to get into today's episode, and we're going to be discussing the psychological effect interest rates are having on buyers in 2025 and the perceived new normal of today's market. We've talked about interest rates on this podcast before, but what I'm seeing happening right now is an interesting thing, and I think it speaks to the buyer's psychology of how interest rates work, and timing is everything. And so the past few years, since the rates have gone up a little bit, we've seen a shift in buyers' mindsets. They were waiting on the sidelines, and now I feel like they've coalesced around the idea that they finally accepted that rates are not heading dramatically downward anytime soon, and have recalibrated their expectations regarding interest rates and mortgage payments. So I want to start off my first question by asking you, do you agree with my assessment that there has been a shift out there in buyers' perception of the market? And have you observed any significant behavioral shifts amongst buyers with the current interest rate environment?
Yeah, that's a great question. And in general, I would completely agree with you. I think the way that I have been hearing from clients and seeing how clients behave, it almost depends on generationally where they are and how rates have been affecting them. So if you start more on the younger side of things, the younger generations that we work with, so more first-time homebuyer clients, they're almost numb to the interest rate environment that we're in now and that we have been in over the last year or two because they really don't know anything other than that environment. So they're not like totally destroyed that, hey, I should have bought when rates had a three in front of them because now they have a six in front of them. It's really the only thing they know. So they don't have as much of a negative outlook, I'd say, based on where rates have gone over the last couple of years, as more so maybe, you have someone that bought a home in the mid, teens of the 2000s and they'd really like to buy a bigger home because their family's grown or they've gotten married or, whatever the reason may be. And, initially they're kind of disheartened that, hey, I have a great rate right now with a three or a four in front of it. And if I wanted to buy a bigger home or move up, I'm going to be in a rate that's in the higher six right now. I think initially those buyers certainly were probably a little disheartened by that. And you very well could see the same and have seen the same in more of your elderly clients that are looking to, say, downsize, and are having a really hard time, going from either no mortgage or a mortgage in a super low rate to, a good bit higher rate in order to do that. But generally, I'd say even those middle to older generational clients, have certainly swallowed that news, swallowed where rates are. And, because rates have been rather consistent now over the last year or so, this is where we are. This is what the times we're living in. And, we've got to live our lives. We've got to move on with it. We've got to, work with it the best we can and kind of go from there. So in general, I totally agree with you though.
I sense that in my buyers, particularly this year, where it's like, all right, well, they are what they are. We waited on the sidelines. We waited for them to go down. We heard that they were going down, last year, let's say, but now they are where they are, and we need to make a move. And, I have one client in particular that it's killing him that he's going to be giving up his 2% interest rate on his house. And he's buying what is now his dream home, right? And he needs to sell that house in order to buy, the move up house. But he's come to the realization, like, this is it. Like, either you do this now or you don't do it. And he's going to miss out on a great opportunity. So he's kind of swallowing that interest rate and moving forward. And I see a lot of people doing it out there. So have you recently, with the interest rate fluctuations in the past few years, has that influenced buyer confidence in the current housing market? What are you seeing in terms of buyer confidence today?
Yeah, I think once a buyer is educated by their real estate agent, they speak with a mortgage professional, they kind of get a much more firm grasp on one, where are rates? What does that mean relative to a monthly mortgage payment? What does that mean in terms of affordability? And they gather that information and they, accept it for what it is. The confidence level in buyers that I've been speaking to, and if we look at the super short term of the last couple of months, the buyers that are getting into the market that want to buy are buying. They need to be able to find a home that they want to buy. But I've been working with, I'd say, a much fewer amount of buyers that are kind of just perusing the market. Would they buy something if they found something perfect? Sure. But that's really hard to find in our market because of the inventory issue that's ongoing. So the seriousness and confidence level in buyers that I've been working with over the short-term past, I'd say the last quarter or two, has been really strong, in my opinion.
Well, I have buyers as an example right now, and they're kind of left with the choice, like a lot of buyers are right now. Their rent is going up. They're currently paying $2,200 a month for a one bedroom. And they're like, this is insane. We have to buy. Now, on the flip side of that, with the interest rates being are what they are, it's probably a little above mortgage payment wise monthly, a little above where they want to be. But I'm convincing them this is the right move. You're not paying somebody else's mortgage. You have the money to make this payment per month. And if you wait further down the line, there's no guarantee that rates are going to go down and the prices are going to be higher a year or two from now, most likely. So now is the time to do it. for them, it's a psychological hurdle to get over. So what psychological hurdles do buyers face when considering purchasing a home at today's interest rates? Let's start there with the actual payment itself, because there could be some sticker shock there for some buyers out there.
There absolutely is. Yeah, I would agree. Payment shock from someone that may be in a situation where, their rent is affordable to them or relatively lower on the affordability side, or maybe, they live at home and, with their parents and they don't have any rent at all. And obviously they might be going from a very low payment to, a mortgage payment. There is payment shock, I'd say. The biggest proponent that I've seen in regards to alleviating that, though, thankfully, has been wages and what our clients make nowadays. And, if you looked at like a pre-pandemic wage level compared to current, you have people that are making 25% or so more than they did pre-pandemic, thankfully, because of wage increases. And I feel like in our area, because of how diverse the employment situation is, number one, we never will see housing market decrease in terms of housing prices go down, because employment is so strong locally, which is awesome. And that really helps our real estate values, but it also helps the affordability issue. So when you talk about, payment shock, yes, you definitely have people that are going to, because of where rates are right now, increase their monthly payment, increasing their housing expenses a good bit. But I think that it's mostly been balanced out by what they make in income is relative to, I'd say most other areas in the country, super strong.
You bring up a great point, because I am seeing, I deal with right now in this point in my career, I'm in my 40s. So I have a lot of buyers who are either on the younger side or they're move up buyers. And, through the process of writing our contracts together, you often see what your client is making in terms of salary if they're filling out a BFI or whatever. And it is pretty amazing, to your point, what some buyers at an early age are making in terms of a living. When I bought my first home, I could only put 10% down. We often see buyers that even in early stages putting more than that down in this environment, which is pretty incredible, because in order to win out during the pandemic, you almost had to put more than, say 3%, 5%. FHA was really hard to get something through the past 4 years or so. So there is a flip side to those interest rates. And like you had said, we have a very strong job market where we are, and that helps to kind of keep everything kind of balanced out. How do current buyer attitudes towards interest rates today compare to those in previous high rate periods? Now, by high rates, you and I were talking about this. We're going to go back to maybe the early 2000s here. We're not going to go back to 1980. We're not going back to 1991. We're talking about, kind of where they are right now, around 7% ish. How have attitudes changed, in your opinion, from the time you started until now?
Yeah, and that's a great question. So, and if you would have asked me this a year ago, I think I'd have a vastly different answer for a lot of the same kind of concepts that we've been talking through. And the reason for that is we went from a rate environment that was as low as it could possibly get, 30-year fixed rates in the high twos, which is, something that I didn't foresee happening, but obviously did occur, but probably won't ever happen again, to where we are now, where if, 30-year fixed average rates are about 7%, that's a humongous move, and it occurred over a relatively short period of time. So, if we thought back to like the mid 2000s, where rates were very similar to where they are now, right around 7%, thinking back that long ago, it wasn't as abnormal for rates to be around 7% at that time for a buyer. Had rates been lower, in the fives and sixes? Yes, absolutely. But had they also been a lot higher? Sure, they had been. So it wasn't as an abnormal time frame as, you look back now, it's been almost 20 years that 30-year fixed mortgage rates hadn't been at 7%. The majority of our buyers in the market didn't even realize that rates had been that high, so they just didn't know. So that's why I'd say, currently with, where rates have been over the course of the last 24 months being, decently consistent and people have been able to kind of adapt to that. I'd say it's much different than if you had asked me that same question a year ago, where it was much more shocking to the consumer that rates have gone so high. So it's a little different, but I'd say we're getting more into that, conceptually and how it feels to a buyer mentally, much more like it had been 20 years ago or so, where it's more normal compared to, say, 12 months ago. That said, too, with where rates are forecasted to be going into the future, lower, but certainly not as quickly lower as, again, about 12 months ago, many rate forecasts were, okay, this is going to be a blip in the radar and we're going to see rates move a good bit lower more quickly. I'd say again, that has taken some time for buyers to adapt to. So confidence levels, I'd say, are increasing again because of that, because time heals a lot. But initially, it takes, it's a hurdle to get through, if you would.
Well, with the relative, stability, with those rates in the past year or so, maybe going back a little bit further than that, are mortgage applications up or down from this time last year?
Sure. Good question. And they're pretty equivalent. If you looked over the most recent 12-month period of time, just from the beginning of last year to where we are right now, the amount of mortgage applications are relatively similar. If you looked, if you brought in the scope and looked back, into the 2023, 2022, they're down a good bit since then. But over the shorter term of the last year over year, they're pretty similar.
Yeah, I find that to be, interesting. Obviously, a lot of the mortgage business is predicated on refis as well. And so I know, there's probably not a lot of people refining at this point in time. How is it from your, I'm going to kind of go off topic here. How is it from your standpoint as a lender? Is there a frustration amongst lenders right now with the market and the way that it is?
That's a good question. Frustration, I guess, having been in the mortgage sales business, in the mortgage world for almost 19 years, is it a vastly different market because you go from, maybe a 60/40, 70/30 type of purchase to refinance ratio in, a more normal market to, 96% purchase, 4% refinance, or something along those lines in terms of the ratio. It's a lot different. I wouldn't say it's, to me personally, it's not frustrating. I can't do anything about mortgage rates personally. Where I kind of put my eyes and move my intentions to is helping the clients that are in the market right now and makes sense for them to be in the market. And right now that is predominantly, 96 out of 100 people is buyers. And, they've got their own hurdles to get over to be able to buy. So it's more effort there. But in some sense, it's also more satisfying. So I certainly wouldn't say it's frustrating because it is what it is. We'll get back to a much more balanced mortgage application market as rates come lower. We've had now a couple of years of buyers purchasing homes with rates in the mid sixes to the mid sevens, essentially. And there will come a time where rates get back into, hopefully something with a 5 in front of it. And those buyers will be able to refinance, and it'll make a whole heck of a lot of sense for them to do so. And we'll get back into a much more balanced market at that point. So, like a lot of things in this world, we're in a very cyclical business. It'll come back around.
Patience is a virtue here. I am one of those people that bought a property a few years ago. I actually used an ARM at that point in time to get, a little bit better of a rate. And I was one of those ones that thought I was smart, and within a year or two, I'm going to refi, and here we are. And rates are still relatively high, so I have my fingers crossed that I'll be refining at a lower rate at some point soon. Buying a home can be a very emotional process. So, do you think that the buyer's desire to own a home is finally outpacing the urge to sit on the sidelines until rates dip significantly?
From my experiences, because I'm mainly talking to buyers that are in the market, I would answer the question yes. Now, that's without knowing. That's without talking to the buyers that are, on the sideline because of where rates are. Could there be, many more of those than what I'm seeing in the market as actual buyers? Sure. But, the first time home buyers that are coming into the market are super motivated. I wouldn't necessarily put those in the category of your question because, first time home buyers, they're either, a few years out of college, they've, earned their way into a good working position, save some money, ready to buy. So it's more of those next step up buyers in terms of how long can they wait before they're more unsatisfied waiting than buying a new home. We're there. There's different classifications and different proportions of those people, but I'd say, we're much more on the other side of that because, again, rate projections are not for rates to come down by 2% in the next year. That's not going to happen. We're not hearing that. We're not seeing forecasts of that, which again is a little bit different than what we were seeing and hearing last year where, forecasting was much more positive than it is now.
Well, with rates being the way that they are, and you said, there's more younger buyers living at home longer. Do you find that those first time home buyers in particular are older? Do you find, those, gone are the days? I don't feel like too many, I may be wrong about this, but I don't feel like too many, say, 23-year-olds are buying homes at this point. Maybe they're more like 28, 29, 30. Do you feel like those buyers are waiting longer because of the interest rates, the rental pricing? What are you seeing out there in terms of the shift, I guess, amongst where first time, quote unquote, first time home buyers are?
Yeah, I think so. I absolutely, and I know there's statistics to back it up. I don't have them, but I know that the age of first time home buyers now is older than it normally is. Why that is? Interest rates have to be a piece of that puzzle. I'm sure that, COVID timeframe is probably some bigger proponent of that too, because, coming out of COVID, you probably had a lot of people that moved back home, didn't necessarily have housing expenses, liked that, but also coming out of COVID, probably wanted to get out of the home too, out of their house and be back on their own. And at that point, it was probably just easier for them to go into a rental, at least initially. The rental market, where I am, it's amazing to see how many new rental apartment facilities, buildings there have been built over the last 5 years. And all you hear is that they're 100% occupied. And it's sort of like, wow, where are all these people coming from? So, yeah, I would say that, that's another piece of the puzzle that has delayed, that first time home buyer from being, maybe more mid 20s into later 20s and even early 30s.
I can't imagine the stress, and this is just me speaking personally because I'm kind of neurotic by nature, but I can't imagine the stress if I'm 23 years old and I'm paying a mortgage of say 3,000 a month. Like that's a heavy burden to take on. I I don't know if I'd be psychologically prepared that young in my early 20s to be able to do that, let alone have a job that would allow me to pay that much per month. So, speaking of, let's kind of shift a little bit, and as we get near the end of this podcast, I want to ask you, with all the things that we talked about, with everything that we've said, how can mortgage lenders and real estate professionals effectively communicate with buyers to alleviate the concerns about the current interest rates and where we are in the market today?
Sure. And that's an awesome question. And it kind of the answer to the question also bridges me to this concept that I love because I find a lot of pride in it is that who you work with matters. You really need to have a team, and speaking from a buyer point of view, you really need to have a team behind you that cares about you, one, but is experienced and knows what they're doing. Because I think the answer to your question, at least initially, is education. A lot of it is educating the buyer. So as you know, a buyer's agent, and I'm not a realtor, but obviously working with buyer's agents every day, I see the ones that take the time to set up an actual, when they start working with a buyer, have an initial meeting with them, whether it's face to face, whether it's on Zoom, whether it's over the phone. It's taking a half hour, an hour to talk to the buyer and really, drill down on one, obviously where they want to move, what kind of home, all that good stuff. But also, to talk about finances, to talk about mortgage rates. And it doesn't necessarily need to be an in-depth conversation of, hey, if you buy a home for A and you finance B, here's what your payment is. But in general, give the buyer a much better idea of what does this price range and loan amount mean for them so that they can ensure that they're comfortable with that. And getting introduced as a mortgage lender from a buyer's agent to talk to a buyer up front is always a great thing in my mind because I'd say a decent percentage, maybe a third of buyers that I begin a conversation with really don't know what their comfort levels are in terms of monthly payment and cash out of pocket and down payment. And that's okay. Being able to talk to someone about that and not just say, hey, your debt ratio should be X and your housing ratio should be Y. Those aren't necessarily answers to the question as a buyer that I want to hear. It's, typically it can be this, but really when you put those numbers in your budget monthly, how does that make you feel? Is it comfortable for you? Is it something you can be confident in, monthly and cash out of pocket wise initially, where you can, proceed with confidence and truly be happy? Because guess what? That's, in the big scheme of things day to day, you don't want someone to buy a home and just be unhappy because they're worried or fearful or what have you. So to go back to your question, I'd say the education aspect of things initially is a huge thing for buyers to, to go through and then develop a relationship with people that they can trust.
Absolutely. I mean, 100%. I want my buyers to have somebody, on the lending side that has their back, and you and I were talking about this earlier. Shout out to my guy Jake Colin. Love Jake, and every time that I pass a buyer along to Jake, I know that they're in good hands, and I know that they're going to be educated on, like you said, the finer points. Not only, a lot of buyers don't even know about closing costs. Like it's not just about down money; it's about what they're paying in closing costs and the total acquisition costs that they're going to be laying out. Monthly payment is their HOA fees. All these things you need to know kind of where things shape up. And like you said, education is key. So, all right. So I have a last question for you. I always like to ask somebody an off the cuff question to end the podcast here. Now, I looked online and I saw that you are a big Pearl Jam fan. Is that correct?
Yeah, you have me pegged. That's correct.
All right, so me too. So,
Oh, nice.
after last night's game, would you rather have an Eddie Vedder autographed guitar or a Saquon Barkley autographed Eagles helmet?
Wow. Great question. Honestly, I would put more value in the Saquon helmet at this moment because I know that's something that I could pass down to the next generation and they would appreciate as much as I can. I'm still working on getting the full approval from my children of the Pearl Jam fandom that I have. And that may come. Got my older son's 12, like I said. He humors me. My wife and my kids named our dog Pearl to again get me on board, which they did. So I'm working on that, but I'd say the Saquon helmet. I mean, after the year that he has had, that would be a family treasure, I'd say, for generations to come, hopefully.
Man, that is a tough call. I don't know how I
Yeah.
would answer that one, quite honestly. So I did have a follow-up question to that.
Mhm.
So what is the best Pearl Jam album? Is it 10 verses or a dark horse in your opinion, like say Yield or No Code?
Yeah. I have an answer, and it's like almost trying to pick your favorite child because I don't know that I want to come out with it. Um, I'm gonna go with Yield. My Pearl Jam fandom started with Live on Two Legs, the live album that came out from the Yield tour. And
Yep.
I'd say if you had to press me like what's my favorite Pearl Jam song, it would be In Hiding. So I'm gonna say Yield, even though again 1A, 1B, 1C, and 1D are all extremely close there.
Oh man, I'll tell you what, you kind of threw me for a loop there. I do love Yield. I do love
Mhm.
Yield. I still have to go. I know this is going to be cliche. I still have to go back to 10 because when 10 came out, I wore that cassette tape out. I mean, there is not one bad song on there. I mean, not that they have bad songs in general, but I'm saying like you could play that. It's one of those albums, play it all the way through. There is just no like filler in that album, and so I feel strongly that I still go back to my 10 days and can relive my grunge years.
Everything you just said is 100% the truth. I can't disagree with it. Um, and I could talk about this all day, but then you have like Vitalogy and you have songs like Corduroy and Immortality, and you're like, I love those almost as much. So there's no wrong answer.
Yeah, Vitalogy, I think would be my number two. I
Okay.
got number two with Vitalogy. So anyway, Mike, we could talk about Pearl Jam all day on the podcast and bore everybody to death, but I think I'm going to let you get back to work. Thank you for joining me on the podcast. Thanks for doing this. I really appreciate your time, and hopefully 2025 will be great for all of us.
Likewise, my pleasure anytime. And go Birds.
Thanks, Mike. Go Birds.
Thanks, Jason.
That was this week's episode with Mike Walsh. I thank Mike for joining us. It's never easy to come on a podcast the day after a Super Bowl win. Here are my takeaways in talking with Mike. Number one, it's never easy to crawl inside a buyer's mind and extrapolate exactly what they're thinking. Buyers are not a monolith and each have to make their own decision. But I think there is some evidence out there that would point to buyers accepting a new normal and realizing that rates are not going to be dipping down to 3% or 4% again anytime soon. And what that means for all of us is that we all have to get past those days of thinking about 2%, 3% interest rates, and hopefully that will lead to more sellers selling and more buyers buying in the year of 2025. Number two, perception is reality. So it is our job to make buyers and sellers, for that matter, who are looking to potentially sell their home and purchase another, to make them aware that we are not going back to those interest rates anytime soon. And if they wait out the market, if they wait another year or two, chances are they will be paying more for a home. So regardless of whether the interest rates come down 0.5%, a full percent, even 1.5% from where we are today, chances are their mortgage payment will look pretty much the same because that home is going to be priced that much higher a year or two from now. So part of our job is to not let buyers have the wrong perception, but deal in reality and let them know where the market is heading. And the last thing I'll say, and Mike says this very eloquently in this podcast episode, who you work with matters. And obviously we know that on the real estate side, but who your clients work with on the lending side is also critically important. I want to be able to lean on my lender, have them educate my buyers as much as they possibly can and make sure that they have their back, because in this environment, every dollar and cent may count towards a buyer's bottom line. And I want my lender to look out for my clients, to look out for my buyers and save them as much money as possible while educating them on the current market and the interest rates. I never want to have to worry if my clients are in good hands or not. So I hope that all of you are using that kind of lender to represent your buyers, especially with the interest rate environment that we're in and the competitive nature of the market today. Well, that's it for the podcast this week. We will be back in another couple of weeks with a new topic, a new guest. And as always, if you want to hear a topic that we haven't covered yet, please reach out to me, jason.ostrowski@foxroach.com. And if you haven't liked and subscribed to the podcast yet or left us a review, please do so. It helps us to reach more people. Once again, this is Jason Ostrowski saying stay safe out there, stay selling, and we'll catch you on the next episode of the Everything Real Estate Podcast.